All right. Welcome to the Big Skinny with me, Lou Basenese, on a manic Monday. Oil prices breached that danger zone I said wouldn't happen last week, but lo and behold, I didn't say how long they had to stay up there to disqualify my prediction because they went north of $118 a barrel. And as we come on the air, last print I checked was 84, a massive 30% increase, and then boom, back below where we started because oil is flowing through the Strait of Hormuz again. So what are we talking about tonight? We're talking about oil. AI job shock. Everyone thinks that AI was eating software jobs and now that's eating the rest of the economy. Not true. We've got two special guests along the way to help us sort the signal from the noise. First is Dr. Mark Skousen, a famed economist, came up with a few economic terms of his own that have been widely recognized as a lifelong friend that has been in the business with me for, decades. We're both getting older. I think we both need to swap out our headshots here. We'll address that with Mark and plenty more on this 205th anniversary of Adam Smith Day, the wealth of nations. And then we're going right into the heart and meat on Meatball Day as well. Yeah, it's a lesser known holiday as opposed to Adam Smith Day, with Josh Young on the energy market. We're talking all things oil, all things his latest recommendations. He started Bison Insights after being an industry insider and operator, has had 2 picks, I believe, that are already 10x. He's got 11 in the portfolio, just made a new one. Not sure if he'll share it on air with us, but I'm sure he will share insights that'll help you make sense of all the noise. And that's what we're here for. The Big Skinny, it's all filling, zero fluff, where we deliver to you every week one headline that you should most likely ignore, one chart that you really need to be paying attention to, and of course, one investment insight at the top of our show and our rundown. And then we stick to our manifesto that we are going to be humble in the markets or be humbled by the markets when we bring on guests that can educate us more and about things that we just don't know enough about. But it's always safety in numbers. There's wisdom in learning in groups and from the conversations with industry insiders and experts. We're going to do that today in our B, C, and D blocks. But first, this week's rundown. Let's get to it. All right, if you're like me, you probably get way too many emails in your inbox, but I love scanning the headlines from the latest financial media to see what they're freaking out about or getting absolutely wrong. And I got to admit, lately, the same scream headline has been just identical. It's just with a different industry in it, that AI is going to disrupt. Insert your favorite sector here. Is it software? Is it finance? Is it the legal profession? You choose. But this week's comes courtesy of PitchBook, those venture capital data crunchers, that AI fright. It's reaching finance. The Wall Street bros are going under and being replaced by the algorithm. I don't think so, but it's a contagion for sure, at least in the consensus viewpoint that AI is going to disrupt and dislocate everyone's jobs. White-collar jobs are going to be out of business. We're all going to be turning wrenches as diesel mechanics. Not exactly true. And here's where I start offering up the contrarian viewpoints. Right? Remember, not long ago, I showed you the chart that showed postings on Indeed.com. But look, I want to just bring you to a headline that actually gets it right. Because when we want to dog on media, financial media that gets it wrong, we also have to applaud those that get it right. And this one comes from none other than the Wall Street Journal, saying that tech has never caused a job apocalypse. Don't bet on it now. And this, my friends, is the right approach. That yes, while there may be disruption from whatever the latest tech trend is in terms of specific jobs, there's always creation on the other side of that disruption. So what we might be seeing now in the software space could open up jobs that 10 years ago we didn't know existed, but they do today. Think about a cloud database engineer. That didn't exist before cloud computing, right? So we don't know what the jobs of tomorrow are going to look like. I can tell you definitively, though, there are going to be way more jobs. And here's funny. Last week, we dogged on Jack Dorsey for AI whitewashing the layoffs at Block. Here's another tech CEO out on Twitter, X. The CEO of Whoop. If you got a Whoop strap, give me a whoop whoop in the comments. Remember, you can join the conversation all day long. Ask us questions. This is a live show. But he's saying, look, we're a tech company first. We're AI forward, and we're adding jobs. So these AI layoffs are just companies that are underperforming, that overhired, that need to right size. And I think this is the right attitude, because remember that software job postings chart I talked about a couple weeks ago. Well, we have a fresh update to it, and it's a little bit of a software rope-a-dope. You saw software postings on Indeed.com just trending lower in the blue line here, and then all of a sudden, a funny thing happened. The number of jobs postings increased relative to the overall job postings in software. But how could that be? I thought AI was going to disrupt software and eliminate all those jobs. Everyone's going to be vibe coding, just needed Claude. They didn't need a real job. Well, the reality is this: the price of AI compute tokens, so to perform a task, kept coming down lower and lower, and lo and behold, no pun intended, what happened? People started doing more and more. So you look at these blue bars here, that's actually showing the amount of AI compute tokens that are consumed. As the price is dropping, you're seeing, look at that, it's traditional supply-demand economics kicking in. When things get cheaper, people want to buy more. When stocks get cheaper, though, I don't know why it is. Nobody wants to buy more, but you should fight the reverse psychology there and do that. But anyway, back to the subject at hand. This is people throwing tantrums about software jobs being eliminated. The reality is more are being created because you can do more. Groundbreaking research that's out recently out of Berkeley, of all places, that followed workers for 8 months, 200 AI workers in the software space that were using AI in their day-to-day jobs. And the study hypothesized that as they used more AI, they would just kind of slack, coast. They'd get their work done easier. And guess what? The opposite happened. They realized they could be way more productive. So these employees started doing more and more. Well, folks, I'm going to tell you, there's going to be a lot of jobs that are in the target, in the crosshairs, that people are saying that AI is going to disrupt. Anthropic even putting out this hit list, showing you in the red regions, the ones that are most exposed to AI disruption, and then the blue are more exposed adjacent. But look, it's leading to more productivity. So long. We can hear you okay, whoever you are, hearing you okay. But we're back live talking about AI disruption. I think that's my buddy Mark. Well, we're going to hear him shortly. But here's the thing. Disruption leads to creation. There's a lot of jobs here that you see that are more blue collar and orientation, energy, infrastructure, production, manufacturing. Those are great jobs that are not going to be disrupted by AI because you absolutely need humans to do it. But they're going to be assisted, right? I think, and my argument is that this really shouldn't be called artificial intelligence. It should be accelerated innovation. And this is our money chart of the week. If you actually look at the number of new business applications since the launch of AI, those filings have gone up and to the right. What does this mean? It means two things. The innovation economy never sleeps. And these are future businesses that are going to need future employees. So yes, even though some jobs will be lost, there's many new jobs being created. And we can look at the earliest indicator of this. Traditionally in my career, it's been patents telling the tale that it was going to lead to future products and profits. Now, folks, it's new companies being formed. So in the age of AI, think about accelerated innovation, not artificial intelligence, sci-fi stuff taking over your job, the earth, and the rest of humanity. What in the world then does that mean for investments? Because every time we come here each week, we want to give you one headline to ignore, one key chart, this one to pay attention to, and one way to increase our bottom lines together. And folks, I think this is the easiest way. Last week, I said I don't want to catch a falling knife in the software space. I told you I would start digging in for a compelling opportunity to buy into the software companies. And this week's buy is an equal weight S&P software and services ETF that will give you exposure to software rebound. We don't have to guess the bottom. And the beautiful thing in this, because it's equal weight, we're placing the same size bets in each company, unlike the market cap weighted ETFs out there that place oversized bets in some of the leaders. So if they don't do as well, it has an undue influence on the entire investment. This one doesn't have that. Remember, we did this with the S&P 500 equal weight, and that's outperforming over the last 4 or 5, maybe even 6 months. I think this is the smartest and safest way to bet on a software rebound in the stocks. This has got 70% application software, about 30% exposure to services software. And I think if a turnaround comes in the near term, it's going to lead to a massive rally in this ETF. And it's a low risk, high potential reward way to play the rebound. And if you doubt that's possible with ETFs, look at what happened this year with the energy ETF that we've been recommending for 5 or 6 months. XLE is up about 30%, best performing sector in the S&P 500. By far, after being one of the worst last year. Turnarounds happen gradually, then suddenly. I think the next one is coming in store for software. So that's the best way to play it, in my opinion. And we're going to give you more insights plenty more with Dr. Mark Skousen after we come back from this break. But I want to make sure you remember to follow us on all the socials. We're on YouTube, streaming live on X. Follow us. Elon Musk said you should follow us. No, he didn't. Not really. But one day he will, and then I'll stop calling it Twitter, because I think it's just Twitter. I can't get it out of my mind. I tweet. I don't X. I don't post on X. But anyway, follow us on YouTube as well, so you'd never miss an insight and never miss an episode of The Big Skinny. We'll be right back right after this quick break.
Check futures, please. We got green. Not a whole lot of it, but it's green. The Dow's up 120, same with the Nasdaq, up 130 points. Lou Basenese with me this morning. Lou, is this the start of a serious bounce back?
It is, and I don't even need a crystal ball to make this prediction. I just have history and earnings on my side. So history shows after every major military event, the markets may be lower by about 1% 1 month later, but 3, 6, 9, and 12 months later, always higher. Then if we look at the earnings backdrop, S&P 500 earnings increased by double digits again for the 5th consecutive quarter at 14%. And it's not just the Mag 7 driving it. You've got the other 493 that increased earnings by 10%. So this is a fundamentally strong market. The war trade is emotional. The earnings trade is mathematical. We're going higher from here for sure.
What are you buying?
I love energy, and I've loved energy for starting in the middle of last year. I still love biotech. Biotech has yet to hit new highs, all-time highs back from 2021 COVID days. I think those two sectors are really attractive. And then small caps. I think we still have in the back half of this year, all this administration and the president's policies are going to kick into gear for this economy. Small caps benefit the most, in my opinion.
Stay with me, please, for the hour. Need more from you later.
All right, stay with me for the next 10 to 15 minutes. Welcome to the show, Dr. Mark Skousen, longtime friend on Adam Smith Day. You know it's Meatball Day too, right? For us Italians that celebrate.
Well, let's indulge with something to eat.
So listen to me. I don't know that you probably predicted today would be such a wild ride in the markets when you're trying to celebrate the birth of capitalism, right? And the father behind it. So what do you make of just all the volatility? I mean, you've seen more ups and downs in the markets than I have by a decade or so. So how do you sort this out for our listeners?
It's funny because Adam Smith advocated 3 basic policies that are necessary for economic growth, and they were peace, easy taxes, and a tolerable administration of justice. And I think 2 out of the 3 are out of kilter right now with the trade war. That's not easy taxes. Those are high taxes. And then we have war going on in the Middle East. And, you know, you talked about the oil price going up to 110. Do you know what really fueled that is Israel, without the U.S. permission, bombed a bunch of depots, fuel depots, of the Iranians. So the supply chain has been disrupted pretty significantly, and it's going to take a while to get back into place. Now, granted, Iranian oil isn't as much as it used to be, but still it's affecting the market. And I think that's a long-term play. I think it's
don't you think that was strategic though? Don't you think that was a strategic move to bring an end to the war quicker? Because Iranian oil, they produce about 5 million barrels a day, and only about 1 million of that or so goes towards export. So if you cut off their supplies, you kind of squeeze them out sooner, right? I mean, you got to put a stranglehold on it to get to the end of this. But what's your take?
That was the strategy, but why do it without consulting with the U.S. forces? I mean, they must be really ticked that this is supposed to be a joint venture. And the fear is that, look, what if you end up bombing actual production? That could be a long-term effect as well. But anyway, it is the supply chain, and that's what caused the price to go up so dramatically, and stocks to, Wall Street is reeling. Look, war is inflationary. War is the health of the state. So both factors are negative for the Adam Smith model of economic growth. You want to have cheap government. You want to have government that doesn't constantly interrupt the commerce globalization. And we're seeing in the trade war and so forth, we're seeing all of that taking place. I have to admit, I'm impressed that Wall Street hasn't collapsed even more. So
you're not normally a guy half glass empty. So this is surprising me. What's the path back to the right fundamentals for Adam Smith? I mean, where do you see one back to cheap government, lower taxation? I mean, is that possible? A balanced budget, dare I say? Are we ever going to see that in our lifetimes?
Well, we're not going to see it anytime soon. Trump himself wants to increase the defense budget, the war budget, let's call a spade, to $1.5 trillion. That's a 50% increase. Deficit is not going to go down. And, you talked about job growth and AI and so forth. It is interesting that I agree with you that AI is not going to be as disruptive. I mean, it's disruptive. It's creative disruption, if you will, that Schumpeter talked about. But it'll create more jobs than it will lose. I'm convinced of that. I use AI all the time, by the way. Any kind of issue or question I have, my students go on AI. They use it all the time. This is healthy. Oh, yeah.
You're an anomaly, because I got to tell people, we've known each other probably almost 30 years now. That's crazy, isn't it? And I know you as just a very well-rounded economist, market strategist, but you also carry around silver and gold coins with you. So the guy that's been a gold and silver bug for his entire life, also being an early adopter of AI is shocking to me. So how did you start using AI? Was it the students? Because you are also a professor that they pulled you into?
The silver coin right here.
See?
To remind me of my roots. Yes, but I'm also into Bitcoin, and of course, Alec Green and others at the Oxford Club we're in dispute over the value of blockchain technology. You've got to stay ahead. I think that was one of the mistakes Warren Buffett made, and why he's not outperforming the market like he used to. He doesn't understand a lot of this new technology, and you have to be willing to look at AI and blockchain technology and everything else that's going on. You don't want to stick your head in the sand and just deal with the past. Right. You have to look to the future, and that's why I'm with the Oxford Club and leaving Eagle Publishing, because they didn't keep up.
Yeah. So it's funny. Let's talk about that. Looking to the future, where do you see? Because look, you have a long track record of very successful stock picking as well. I think most people think of economists like weathermen, right? You can be right. You got 3 of the last 2 recessions properly predicted, but you have an amazing track record picking stocks. Where are you finding opportunity in the new technology related names here in this market for our listeners? What do you like in this market that seems to be overinflated sometimes in tech?
Well, I have to, humility was one of the virtues you're talking about. I lucked out that just as I switched over from forecasts and strategies at Eagle Publishing over to the Oxford Club, there's very few areas that I've seen much opportunity, to be honest with you. I have 17 positions. This year, 10 out of the 17 are still profitable. So I'm up 8% on average, which is not bad. But since this war has occurred, it's hit pretty much everything. It's very hard to hide from this sort of thing. The one stock that has done well is my penny stock that I'm promoting for people to subscribe to my newsletter. And I'm not going to reveal it here, but it's done well. It's up almost 40%.
Well, you can't give it away because it's a marketing thing. So people need to go to the Skousen Report on the oxfordclub.com. But can you at least tell us what sector it's in? And let's separate penny from promotion, because you're not a promoter. It's used for marketing. It's an actual fundamental analysis. I know you can be humble, but I can brag about you. That's what friends can do.
Well, I would say that this is in the commodity sector, and it's one of those critical elements that it's called the magical metal. And I'll tell you, this is where the Trump administration is involved, and they're actually buying companies of critical elements. That's a new phenomenon and so forth. So I think there is opportunity there. And somebody mentioned biotech. I actually think biotech never really after COVID. There was a lot of interest back then, but it's more of it's a underperformer compared to the Magnificent Seven. So Amgen is one of my favorite stocks, and it's up 12% this year. And I must say, defense stocks is another area that I am bullish on. So I am involved in that, and I do have a couple of energy positions. So these have done well. It's the commodity sector and defense spending, if you want to name some sectors that I think have real potential. But unfortunately, you don't want defense spending to go through the roof. That's an indication that government is too invasive, engaged too many foreign wars and stuff like that. I'm in it just because that's where the market is going. But AI, I think we're in the middle. I mean, it's 2026. We're in the middle of this AI technology revolution. That's what I'm
How long
going
do
to
you think it can last? And when you say middle, we're what, 3-4 years in by your estimations? We got another 3 to 4 years of really seeing the productivity gains and profits drop to the bottom line on companies?
Yeah, it's another roaring 20s. I see it as a repeat of the roaring 20s, which of course
I was not
badly,
alive,
but,
Mark. I don't think you were either, though, right? Please
what?
tell me. I said I wasn't alive during the roaring 20s. You got to remind us what it was like.
Oh, you are bad. I'm not that old.
I know.
My goal is to continue to write the Skousen Report until I reach my next Fibonacci number. Do you know what that is?
Yeah, I don't know what your next Fibonacci number is, so you'll have to tell us.
Well, it's not 144.
Yeah. So speaking of the Skousen Report, because you did just switch to come work with the Oxford Club, Alec Green, Mark Lichtenfeld, those guys, again, fellow friends and colleagues. Where can everyone find your latest research and where can they find you online as well?
Well, if they go to SkousenOxford.com is the website that they provided for me right now. I'm still waiting for Eagle to have transferred markskousen.com. And until they do that, if they go to Skousen, SKOUSEN, I don't know if my name is up on the screen, SkousenOxford.com is where they can find more information about my newsletter, monthly newsletter, plus a hotline. And one other thing I want to mention is that Adam Smith was a genius. He created a formula so that he could convert private self-interest into the public benefit. And he called it the invisible hand doctrine. And he did it by devising a system where you channel private interest through the rule of law, basic judiciary controls, laws of justice, and robust competition. And you talk about competition all the time in the stock market. And that's where Adam Smith has achieved his great success and why we're celebrating Adam Smith today.
Well, listen, Mark, I always appreciate your insights. I'd love to have you come back on the show when you're in New York next time. We can sit here and have a proper, lengthy conversation. We do have a question here from one of our most prolific commenters, Chad, a fan of the show, great guest. Do you feel copper is a strong accumulation in 2026? And what position does he add for, what do you think about Bitcoin and Ethereum as well?
Yeah, so copper is one of my 17 positions, and it is one of the strongest performers this year. So I've been recommending it. Southern Copper, in case anybody's interested, you could take a look at the chart on that. I think it's much better than Freeport-McMoRan. And then as far as cryptocurrencies are concerned, I think they're bottoming here and starting to move up. But my approach is to go through an ETF called Amplify Fund, symbol BLOK, because that deals with companies that are advanced. And by the way, I like your AI reference. I call it advanced technology or advanced intelligence, not there's nothing artificial about it, right? So,
no, there's not. But I got to ask you, have you ever looked at BTGD? It's an ETF. It's stacked 100% Bitcoin and 100% gold exposure. So that way you can carry on your.
Wow.
Yeah, it's a combo. So you get exposure and it's got some trading around the contracts that actually generate some income. So it's one to put on your list too. We've had it here on the show. We're looking and talking to the creator behind it here before long. But Mark, I always appreciate your insights, and I encourage everyone here to check out SkousenOxford.com to get the latest from Dr. Mark Skousen on National Meatball Day and Adam Smith Day. Enjoy your celebration, my friend.
Thank you, Lou. Real pleasure.
All right,
Take care.
We'll be right back after a short break to talk all things energy, oil, volatility, with another prescient market caller, Josh Young of Bison Insights, right after this break.
That weeks, not months, answer from Secretary of Energy Chris Wright was in response to a question from Lawrence of how long before we see relief at the pump. And I don't like weeks, not months. It's an honest and frank answer, but certainly not a soothing one.
No, but I think he did put his finger on the right point. No pun intended. Chris Wright has said that we've been held hostage by Iran on these the Strait of Hormuz for 47 years. And if I look at the price curve for oil, futures markets are pricing in it coming back. Prices coming down. I get 3-4 months out, we're back into the low 70s. We get back into the 60s by the fall. So I do think it's all about duration. How long does this last, and how fast do prices go up? Taylor, you said that in the first hour. If you look, unfortunately, there's an undeniable trend. When oil prices go up in a short period of time, more than 70 or 80%, a recession follows, because it destroys demand. Everyone cuts back. It really puts a halt to economic progress all across the globe. So I think that's the real risk here. But I think you said it. The president made a calculated decision, right, in the first hour. Like, hey, we're going to endure this in the short term to have security and stability in the long term. So he knew prices were going to go higher from here.
All right, welcome back to the Big Skinny with Lou Basenese and Josh Young of Bison Insights joining us on a day that probably goes down as one of the most volatile in the oil markets that I've ever seen. How about yourself, my friend? You've been in it a lot longer than me.
Yeah, this has to be the biggest two-way move I've ever seen in one day.
How do you, I mean, just take us through, because you're an industry insider, you were an operator, you were an investor in this space. Now you continue to be an investor advising funds, your personal portfolio, but then you have a newsletter. I mean, take us through your day today. What were your thoughts as you wake up, oil spiking above 110, and then, before we came on the show, I think it was at 84. So walk us through like your thoughts and what you make of it and how that changes your outlook for the rest of the week, maybe.
Yeah, well, I think it started over the weekend where the U.S. and Israel bombed some fuel depots in the Tehran area, and it sort of went all over social media and all over the news. And that, I guess, was sort of the culmination of a lot of news around oil supply disruptions over the past week. And so you had seen oil prices sort of leak higher over the week, but they had stayed relatively subdued. And I think that was maybe the catalyst for animal spirits to take over. You saw oil prices skyrocket in the evening market last night. And then actually by this morning, they were already starting to come off. And you basically saw them bleed down all day today, which was it was sort of wild to watch.
Yeah. Do you think that was, though, an indication, the market price reaction of when there seemed to be a breakthrough in terms of flow of traffic through the Strait of Hormuz? You tweeted out basically the bar chart. I remember seeing it of here's the normal volume of traffic through the Strait of Hormuz, and then boom, here we are, like basically hit the bottom. Do you think this is an indication, the market reaction of just, hey, this isn't a supply problem per se, this is a war conflict problem, and as soon as this ends, the bottom's going to fall out on prices again and go back, into the 70s?
Yeah, I think that's the narrative. I think and there's been now some narrative talking about individual tankers that have made it through the strait. The problem is that when you add them up, they get to those low levels that you see on that bar chart, not the high levels that you saw previously. So yeah, I think that's definitely the narrative. But you have, it looks like 6.5 million barrels a day shut in right now across various Middle Eastern countries and fields, which will take months to ramp back up. And then you have Qatar's LNG export facility and some of their gas fields now shut off and shutting in, which will also take weeks, if not months, to ramp back up.
So even though the conflict could end in weeks, not months, as the administration is trying to project and market, really the disruptions here could be months for sure. I want someone like you. Look, you were early and contrarian, but dead right. I mean, I think we were going back to October of last year. You started making the point that, gold moves first and oil's eventually going to follow, and here it happened. What's your market view for the rest of the year in light of, this just sudden spike and pullback? How do you think the market digests that? Do you think U.S. operators start, raising rig counts, or are they just kind of locking in hedges on this move and just continuing their production at just maintenance level?
So first of all, I'm a oil and gas equities investor rather than a commodity investor. I might have made a lot more money on the commodity if I had owned options on oil and then just sold them. But the weird part is that the equities basically haven't moved as a set. If you look at XLE or XOP, some of these big ETFs, they basically are at similar levels or even lower than where they were from the time that the U.S. and Israel started their war with Iran. So there hasn't really been anything to sell into per se. I think there's been this sort of reactionary trigger to sell the news, but what sell what at what price. So it's
they
a
didn't
very,
move up.
yeah,
Yeah,
it's
go
very,
ahead. Sorry.
no, it's okay. It's a very tough thing to even think about as an equity investor. So yeah, are rigs going to come back? Sure, they should. What you need to see is the back end of the curve rise for producers to be able to lock in the price, at least for the first 6 months of production, in order to justify the capital spend on new wells. And the reality is that, the back end of the curve started to rise, and then today it fell. And so I think what we're seeing is a concerted effort by the Trump administration to suppress the oil price and change the narrative. And the downside is that they've been doing this for the last year. This is sort of what I was talking about when I was highlighting the deviation between gold price and oil price and some of these other commodities. Suppressing the price just leads to explosive moves like we just
It
saw.
just makes the crisis worse later on, right? I mean, they're really, stored buying of the commodity later on by pushing the price down in the short term.
Exactly. And you'd hope that the president would know this from his background in real estate, but it appears that he just has like an emotional negative association with oil. And to me, this is where I think I have a variant view from the market. I see that as incredibly bullish, because when I look at the government's ability to affect a global commodity price through narrative and through price setting and through hostile policy approaches, what I see is a history of failure with that and a history of much higher prices. Incidentally, the last time a president was this aggressive at suppressing prices, it was Nixon in the 1970s, and that was a spectacular time to be an oil and gas equity investor.
Yeah, I want to say too, you've been very prescient with your calls. I think you launched Bison Insights maybe 6-7 months ago. You've had 10 or 11 recommendations, all doing well, including one that was up over 1,000% in the last month or so, the Battalion. So tell me how you look at, and for everyone watching and listening, the live or the replay, I encourage you to check out Josh's work. I'm a paid subscriber. It is worth its weight in gold, and you're now discounting it even more to make sure more people get access to it. But tell me where you see opportunity right now. Are you looking at more in the distressed end of the market? Are you looking, U.S. domestic? Are you looking in Canada, international? How do you view the set of opportunities when you survey the landscape of oil and gas investments?
Yeah, so I don't want to take credit for stuff that I didn't get right. So I didn't own Battalion. What I used, the most recent idea, I used Battalion, which was up a lot, and another company that also has a big following that's up a lot, as analogies for the latest idea that I shared.
Got it.
So I've had a few that worked really well. In aggregate, these ideas have way outperformed relative to XOP, which I've been using as sort of a ETF benchmark, sort of, hey, if you could own XOP or you could own some of these specific ideas if you're bullish on oil and gas equities. So I look all over. I've shared ideas in the US, producers and service providers, Canadian service providers, Canadian producers, and then international producers and services companies. So sort of all over, just trying to find companies that are very low valuation, that have some sort of identified catalyst that could allow the valuation to rebound substantially.
So a very asymmetric setups, right? Because in a lower price commodity market and lower valuation, and with catalysts, I mean, the goal here is to take less risk, but have an asymmetric return potential. And how do people find out what's the website? I know we've got a QR code to bring up on the screen. I want to make sure people see that a few times so that they can take advantage of it. But what do you think about portfolio construction? I mean, at any given time, I think you have 10 positions, 11 positions now. Do you cap that out at 15? Is there a kind of upper bound and a lower bound? Do you run a concentrated portfolio? How do you think about portfolio management? Or you just said, hey, man, there's a rising tide that's coming. We're going to make sure we get all the right exposure as long as you find opportunities that are compelling.
This is a great question. So my day job is running an investment firm where I have a portfolio and I sort of force rank stuff and sell stuff that I don't like and buy more stuff. The Bison Insights is sort of a fun newsletter hobby that's turned into a little bit more as it's really taken off. Some of these ideas have done spectacularly well, not 1,000%, but a couple are pretty close. And so, I think what I'm going to do with it, it's less about force ranking. The nice part is what I found, none of these are actually recommendations. They're stock ideas with the analysis that I think it's not everything about the company. It's the things that I think matter most for my investment thesis, along with key risks.
Right.
And so what I think I'm going to do is just share when I'm selling or when I've sold ideas. And then once I'm fully out, I think I'll just stop. I'll crystallize the performance from that particular idea versus XOP, continue to show the performance, but no longer, just be very clear, hey, this was the idea and it's no longer something that I own. But that's less force ranking and more just sharing ideas that I think are compelling and why I thought they were compelling. And hopefully, honestly, I think it's very unlikely that the next 10 ideas that I share will do anywhere as well as the last 10. And again, I missed Battalion. I got a lot of other ones, and just it's been so spectacular that I just want to level set. Like, it's probably not going to do as well as it's done because just mathematically it's almost impossible.
Well, I think people can appreciate that viewpoint, because if you're out here banging the drum, like, this is going to go much higher from here, all these names are going to, I think it would raise some skepticism. So it's good to hear the level-headedness and humility about it. How frequently are you finding new opportunities in this market? I mean, is it once every month or so? Again, I know that's a kind of a fluid situation, but in this dislocated market where you're talking about XLE really didn't move much on this conflict and war, are you seeing valuations stay depressed where you can find a new opportunity once a month or once every 2 months?
Yeah, so the concept is to share one stock idea a month, and I failed at that. Launched 8 months ago, and I've shared now, I think it's 11 or 12 ideas. So I've been oversharing a little bit. My expectation is that over time, I'll probably share fewer new ideas and more updates, just because the pace of idea sharing probably has been a little too frenetic. But yeah, it's been, what is it? Warren Buffett has all these great quotes about when he sees a opportunity rich environment. And I would say this environment's extremely opportunity rich, but I'm just trying to be really careful about only sharing ideas that I think are incredibly compelling. And I think being careful with that, there's even stocks or warrants or various other things where I'll go buy a little myself or in my fund, and I'm not sharing them just because I feel like it's not ready for prime time per se. And so I'm just trying to be really careful with that to preserve the track record. And again, I won't do as well as I've done. It's impossible to, but hopefully I'll do really well. And hopefully people from here will be pretty happy with the ideas that I share.
Victim of your own success in under 12 months, my friend. Well done. Listen, I appreciate your perspectives in the newsletter. Appreciate you joining the show for the second time, sharing your perspectives. I hope we don't have many more days like we had today, but if we do, I'd love to have you back on to decipher it all for us. So appreciate it.
Thank you.
All right, folks, now we're going to get to some more insights, kind of some headlines and head scratchers, a segment where we look at calls we made before or just things that make us scratch our head because they don't make much sense. So make sure that you are following us. Make sure you're following our guests as well. Josh puts out just a ton of content on X. Josh Young 1, I believe, is his handle, but we'll put it up on the screen again. Follow Lou Basenese on X, and then Mark Skousen 1 as well. You're going to get nonstop insights and all across the market. And we're going to come back with some more with the Dodd man in the D block right after this.
That weeks, not months, answer from Secretary of Energy Chris Wright was in response to a question from Lawrence of how long before we see relief at the pump. And I don't like weeks, not months. It's an honest and frank answer, but certainly not a soothing one.
No, but I think he did put his finger on the right point. No pun intended. Chris Wright has said that we've been held hostage by Iran on the Strait of Hormuz for 47 years. And if I look at the price curve for oil, futures markets are pricing in it coming back. Prices coming down. I get 3-4 months out, we're back into the low 70s. We get back into the 60s by the fall. So I do think it's all about duration. How long does this last, and how fast do prices go up? Taylor, you said that in the first hour. If you look, unfortunately, there's an undeniable trend. When oil prices go up in a short period of time, more than 70 or 80%, a recession follows because it destroys demand. Everyone cuts back. It really puts a halt to economic progress all across the globe. So I think that's the real risk here. But I think you said it. The president made a calculated decision, right, in the first hour. Like, hey, we're going to endure this in the short term to have security and stability in the long term. So he knew prices were going to go higher from here.
All right, we're back for the Dodd man in the D block, headlines and head scratchers. Man, I'm going to come to you because you're not a Wall Street veteran, right? I mean, you're newer to all of this. Like,
How
what
can
do
you tell? I mean, really?
You know what you are, though? You're a purveyor of national holidays who was the one that told me it's National Meatball Day, which just gets my Italian heritage excited. Thinking I have a meatball parm for dinner. But, I mean...
And a great Bill Murray movie. Come on. You know,
yeah.
meatball.
What do you make of a day like this? I mean, you're an investor, but you're not a lifelong investor. You see crazy headlines about oil spiking and then collapsing. I mean, what runs through your mind?
It just, the volatility is what seems crazy to me, because, you know, with everything we've been talking about with oil, you know, up and down, and then, you know, coming off of AI up and down. So it's just, I don't know if this is the, what's in my mind is, I don't know, is this the new norm, or is this just, you know, certain times? You know,
Yeah, I think it's a great question. I think volatility is definitely a new norm, even though if you look at the VIX, which is the traditional measure of volatility, you haven't seen a higher frequency of massive spikes in the VIX. But I do think in individual investments or sectors, because of the retail participation, we talked about this last week, it just leads to these massive price swings that are a lot more frequent and severe in magnitude, both up and down, than we've had to deal with in the past. And look, we got the rundown here for headlines and Headscratchers and oil oops, because Genius Me wrote a piece last week that said oil 100, recession, don't hold your breath. And then sure enough, is, you know, the thing about making predictions is it's tough, particularly about the future, as Mark Twain said. It happened, right? And so I got to own it. But I will say this, the market reaction, it just breached 100 and then pulled back so quickly. And that was the key in that article as well. Duration matters. How long we stay over 100 or how long oil prices stay high is what impacts recessions. I don't think, 36 minutes above $100 a barrel or whatever it ended up being, a couple hours is going to be enough to cause a recession.
And this may be a really dumb question, but any clue on, like, is this just going to keep going up and down, or are we kind of like it spiked and we're kind of might settle?
I think this was the massive spike, right? I think barring some unexpected turn of events where the Strait of Hormuz completely closes down again and Iran's got missiles and are attacking tankers, I don't see us going back to the 118, right? So I think Israel attacking and taking out some depots and supplies was very strategic. And I think this administration is extremely focused on shortening the duration of this conflict as opposed to lengthening it. So anyway, hide or seek, it does bring this up. You talked about the volatility in the markets. Howard Lindzon, who runs StockTwits, the inventor of StockTwits, a great VC investor. The title of his newsletter yesterday was "Fear and Uncertainty Are Spiking. Is there anywhere to hide?" And funny enough, I mean, energy didn't sell off or spike too much. Josh brought it up. I mean, the energy sector is still the best performer for the year, up 26%. Small cap still hanging up in there, up 2%. So as long as you didn't bail and get scared stockless on this volatility, you're doing okay, unless you owned, nothing but software stocks in your portfolio.
Yeah, and besides Mark saying that he had a penny stock that commodity was in the commodities sector that he could recommend, that other than that he didn't see very many places to hide. Do you feel the same? I mean, is it really
this is one of the, it's a great question. I mean, here's the fundamental question: should you look to hide in times of market volatility? And I would tell you from a fundamental perspective, absolutely not. Josh started bringing up the great quotes from Buffett, the Buffettisms, be fearful when others are greedy and greedy when others are fearful. So when things get ugly out there, you should be doing the opposite, not looking to hide. You should be looking to buy. Traditional safe havens, gold has always been considered a safe haven. U.S. Treasuries are the ultimate safe haven. Some would argue that having cash is a safe haven, right? If you just move off to the sidelines. But my problem is with that is, how do you know when to get back in? So to be a market timer, to do it right one time, you got to know when to get in, get out, and then get back in. That means you got to be right 3 times, not just one time. So
and we've learned about trying to time the market. That's just insanity. But that brings up a good question, because as you were saying that, I was thinking, as a investor, as you said, I haven't been doing it for as many years, but I don't have a lot of cash on the sideline, because what I have at work, if you will. So like, do you think that you should always have a little for these times, where it's time to buy, you can do that?
I do. I think you should have a 5% cash position at all times. I mean, at some point, you're going to be fully invested. I strongly advise against using margin. Don't fall into that temptation. That cuts both ways. So having no cash and then spending cash you don't have, basically borrowing to buy more, is not a prudent move. But I also think, Josh talks about force ranking his positions. When say you're fully invested and a market sell-off happens like this, I think you got to be looking at, hey, is something I really want to buy that got attractive worth buying and replacing what, the laggard in the group, the one that's ranked, if it's 1 to 10, is the 10th least bullish investment you have. You have to be willing to let go with your investments. I mean, Mark Skousen, one of our colleagues that he works with now, Alec Green, says, don't fall in love with your stocks, fall in love with your sweethearts, right? It's easier to separate from a stock when you don't fall in love with it. You don't want to separate from your sweethearts or your spouses. So
good advice.
Yeah, just in case my wife's watching, so I don't get in trouble.
Different channel though for that. All right, next one, predicted it. Obviously, this is the predictions market back in the headlines again. I think this is a new mainstay. Kalshi getting sued for, again, about the Iranian supreme leader. I guess what was it? A transition, but he ended up dying. So the fine print said it couldn't be because of death.
$54 million worth of payouts that are being withheld. I think this is, we predicted in our predictions episode that the predictions markets would have a tough go this year, that they were going to peak. And now we're seeing headline after headline, problem after problem, not paying out. Wild speculation. I think, look, the devil's in the details in the fine print. We had an insider trading issue with Kalshi and Mr. Beast, one of his employees. So I just think we're going to see a lot more. We predicted it. I hate to say I'm right. We didn't. We tried to focus on our prediction episode and nothing but positive predictions, but we threw in two skeptical ones on IPOs, the big IPOs, and the prediction market. So far, so good on that front.
Yeah, I think the days are numbered for the predictions market.
Yeah, they're going to be regulated whether they like it or not. Welcome to SEC FINRA land, like every other publicly traded company.
Yeah. All right, buckle up. So this is again, more of the same, but 100-day intraday Dow declines, and it's been picking up over the past years a lot. You can kind of see the scoreboard up there, but from Obama, Biden, and Trump. But is this a story of volatility, or is this because the market has gotten so big?
So many questions. Look, there's no definitive answer here, right? Some people will see this that can not look at anything without making it politics and partisan, and they're going to say, see, it's a Republican problem, not a Democrat one, because Biden, was a Democrat, not as good of one as Obama in their mind, so there's less volatility. I think this is a structural change in the markets. It's never been easier for investors to invest quickly, affordably on credit cards, in fractional shares through ETFs. You run down the gamut. You can leverage up 20 to 40 times in the crypto market. So all that is kind of the ingredients for more volatility. And I think it has nothing to do with the person in office and more to do with the world we live in, and the ability and speed at which people can change their mind and change their investments.
And I think
buckle up, Buttercup, because I don't think the volatility is going anywhere. If you're going away anytime soon, if you're waiting for smooth sailing, you're going to be waiting on the sidelines forever.
Yeah, and I think you asked me before, to start the segment, what's going on in my mind, and talking about volatility. I think it sounds like to me that the ETFs, that type of balanced play, might be the safest thing for an investor like myself. That's a little bit more risk adverse. So
no, it's a great point. And I always say, when people ask, like, what's your overall strategy? This is not personalized investment advice. I'm not giving that to you, but in a general sense, you take 70 to 80% of your investable assets and you put them in ETFs, diversified, asset allocated across sectors and market caps and styles. And then it's really that 20 to 30% that I think you speculate in the individual stocks, right? So, right now I would have been overweight, and I have been, in the energy ETF, the small cap ETF. You can play that with a small cap value. So if you're looking at your 401k plan, you look at those options that are available. And then when your favorite buddy has a great stock tip from the water cooler, you're not plowing your entire portfolio into it. You're taking like a 1 or 2% position in that speculative side. And I like to look at it and think of it this way: is that big chunk that's in the ETFs, in low cost ETFs that are diversified, make sure you can retire or meet your goals, whatever they are for investing. And that other speculative portion changes the nature of that, right? So you go from eating cat food to caviar if you pick some really good individual stock picks, or, you just get by and you have Social Security, but you got things provided for. So again, that in a day and age when you got, crypto bros that just want to leverage up to the hill and be instant and overnight millionaires. I mean, those two things fight each other, right? Culturally, it's saying get rich quick. Strategically, it's, it's time in the markets, not timing the markets that matters.
I think you just said leverage everything, buy Bitcoin is the only way I'm going to eat caviar. Got it.
Yeah, that's about it. Yeah. You're going to be robbing it from the store shelves if you pursue that investment strategy.
Hi ho. Uh-oh. This is
the economy.
I'm lost again. This is AI, right? It's all AI's fault. We're going to point and blame AI for this.
Blame AI. It's easy, right? Just scapegoat it on AI. No, look, we had that 130,000 job print in January. You see that big uptick there, still well below the averages from 2022, 2023. But again, partisan politics and just reality, you look into this data, it's a lot of noise because obviously coming out of COVID, we had tons of government hiring, healthcare hiring. And I think that's the key point here to take away. Not that I predicted that the jobs market was weakening or just soft when people were saying it was recovering after that January. Is just there's a lot of noise in this. Some people will say the continuing claims number, how many people are out of work, seeking continuing unemployment claims, is a better read. I think you just got to expect volatility and look at the long-term trends. Even if there's a lot of noise in it, the trend is still instructive. You're coming down from an economy that was generating an average of 350,000 jobs a month to less than 50,000 last month. You need to see that trend reverse. I think you'll see that later in the year. There was a lot of government waste and overhiring in the government sector that we're working our way through. But again, all this to say, bring it back to the Fed. Fed needs to cut interest rates. We talked about it today on Fox Business. I think we're waiting for Kevin Warsh, which means probably May, the next Fed chair, before we get another interest rate cut. So hi-ho, it's not off to work. A lot of people go based on the latest jobs number, but I think it's a short-term transitory thing that, God, I can't believe I just said that out loud because that's what doomed Powell said. Inflation was transitory. A weak labor market's transitory. I think it is if we lower interest rates and get out of this war quickly.
Let's hope so.
All right, man. Well, before you run, we want to run through a few more things that you got to keep an eye on. Again, these are some closing thoughts that I think are relevant. The first is the tech wealth effect. You heard so much about tech dominating the market. If you look at household net worth, it's ballooned to the top on the heels of a massive stock market rally. But if you look on the right, that's the concentration of the tech sector in that rally. So all things hinge on tech. Not just thriving. They don't have to be gangbusters again, the Mag 7. It just needs to stay in there. Otherwise, people's, what the wealth effect is going to kick in the opposite way. It's the less wealth effect that'll hurt our economy. I don't think there's anything desperately at risk or urgently here, but it's just something to keep in mind. This is why the stock market matters so much, because so many people are invested unlike ever before. The other thing to keep in mind is the divergence, right? This week, we jumped on the bandwagon of buying the falling knife, but in a smart, prudent way with the equal weight software ETF. But if you look at semiconductors versus software, you've seen a recent divergence. I think semiconductors are the long-term forever growth trend. You have to own it. It's not an either or, but I think software now is becoming a compelling buy. But the reality is everything we do, consume, uses chips. There's over $1.5 trillion sold each year. So go long chips forever, go long cybersecurity forever. I don't think those are trends we'll ever catch up to. Joe from Philly, with Oracle reporting tomorrow after the close, any thoughts? Stay away, my friend. It's never smart to buy or sell around an earnings report. If you learn anything from that, Dodd, I think you've learned that in your shorter experience in the markets. Too volatile. Wait, there's actually... Did I ever tell you about post-earnings announcement drift, Dodd?
I don't think you did, man.
Yeah, because it's about the least compelling and fun story, right? It's not something.
It sounds really exciting, though.
It's a well-documented phenomenon, Joe, that I advise you to follow. Instead of buying before earnings, you actually wait. And the whole theory here is, and the data behind it backs it up, is that great news doesn't get priced into stocks after earnings right away. It usually takes about 60 days. So if a company crushes it and the stock doesn't really move, earnings are going up, margins are going up, revenue's going up, and it's a continuing trend, those stocks tend to outperform even after a jump after earnings. Even if they go up 10%, they just kind of tend to drift hence the name PEAD, post earnings announcement drift. I think it's much more prudent to be buying after, which people are like, well, what I got to pay up if I bought it today? Guess what? You don't know what's going to happen tomorrow. That NVIDIA stock that you thought would go to 250 on a great earnings, the greatest earnings report they've ever had, actually went sub 200. So wait for tomorrow on Oracle and let's see what happens. Dan Niles is big on pins, PI, water cooler from Chad. Lou, do you know Dan Niles? I do know Dan. Dan tends to be glass, like got a few drops in it, especially when we're talking about tech. He's been very negative. We've been on the opposite side on Apple forever, but super sharp. He does make some more tactical adjustments much more frequently. So I don't know if that means he changes his mind frequently or he just looks and trades more than I do and I invest. So I don't know that it's an apples to apples comparison, no pun intended, but super sharp guy. I just find myself not agreeing with him very much. Bingo card, any updates since last week in the last 30 seconds before we wrap?
I think $80 oil we did last week, but that went up even further. But I'm not sure if there's any updates this week. You know, Elon Musk still hasn't followed us, and we still haven't gotten the 1 million views on YouTube yet. Or on X, but
we'll get there. Rome wasn't built in a day, buddy. Here we go. We'll get there. We got
all your friends.
Yeah, we got a lot more months left in 2026 to get there. Well, we want to thank you, our loyal listeners, for always tuning in Mondays at 5 p.m. for the Big Skinny with Lou Basenese and the Dodd Man and all of you. We'll be back next Monday live, same time, same channel. You know where to find us. And check out our newsletter at thebigskinny.com and get insights throughout the rest of this week. Lou Basenese, signing off.